Mergers and acquisitions formula. First one, synergy. Synergy equals to value of AB minus value of A minus value of B. Share exchange ratio or swap ratio on the basis of MPS, EPS, intrinsic value per share or net asset value. On the basis of MPS, swap ratio equals to MPS of vendor company or target company divided by MPS of purchasing company. Swap ratio on the basis of EPS equals to EPS of vendor company or target company divided by EPS of purchasing company. Intrinsic value per share or net asset value. Swap ratio equals to book value per share of vendor company or target company divided by book value per share of purchasing company. Intrinsic value per share or net asset value per share. What is intrinsic value? If vendor company closes as of now, how much amount does equity shareholders get is the intrinsic value. How to calculate intrinsic value or net asset value per share? Sundry assets minus outside liabilities minus preference share capital gives net assets divided by number of equity shares gives net asset value per share. How to calculate book value per share? Book value or net asset value per share. Equity share capital plus reserves and surplus gives net worth divided by number of equity shares gives book value per share. Next, if in the question post-merger price earning ratio is not given, then price earning ratio of the purchasing company before merger shall be considered. Market value or market capitalization equals to MPS into number of shares. Free float means without promoters holding. How to calculate net worth? Net worth equals to equity share capital plus reserves and surplus. Number of shares equals to total share capital divided by paid up value per share. MPS, free float NPS equals to free float market capitalization divided by non-controlling interest holding. Return on equity equals to a return divided by equity shareholder funds or EPS divided by book value per share into 100. How to calculate growth? Growth equals to B into R. B means retention ratio, R means return on equity. Total earnings equals to number of shares into EPS. EPS post-merger of vendor company or target company equals to EPS post-merger into swap ratio. MPS post-merger of vendor company or target company equals to MPS post-merger into swap ratio. Capital adequacy ratio. Capital adequacy ratio equals to capital divided by risk-weighted assets into 100. Higher capital adequacy ratio is good. Next, capital reserve or gain from bargain purchase equals to net assets minus purchase consideration. How to calculate goodwill? Goodwill equals to purchase consideration minus net assets. Next, while calculating minimum share exchange ratio, consider equivalent MPS. Equivalent MPS means MPS multiplied by exchange ratio, that equals to MPS into swap ratio. Higher capital adequacy ratio is good. Swap ratio, in case NPA is there, NPA non-performing asset is there, swap ratio equals to gross NPA of purchasing company divided by gross NPA of vendor company or target company. Gross NPA will not be swapped, negative parameters will not be swapped. What is meant by swap? Consider a base value 100:20, swap ratio will be 20:100. In case of negative parameter, swap ratio will be 100:20 only. Next, perpetuity needs to be calculated an year in advance in the year of stabilization. Number of shares to be issued equals to number of shares of vendor company or selling company into swap ratio. Post-merger EPS equals to combined earnings divided by total number of shares. Operating statement. Sales minus operating cost gives operating profit or EBIT, minus interest gives EBT, minus tax gives EAT, minus preferential dividend gives earnings available to equity shareholders divided by number of equity shares gives EPS into price earning ratio gives MPS into number of equity shares gives market capitalization. How to calculate maximum value? Maximum value equals to post-acquisition value minus pre-acquisition value. Minimum value equals to pre-acquisition market value of target company. Consider opportunity cost also if required. Gross NPA ratio equals to gross NPA divided by total advances. Next, net NPA ratio. Net NPA ratio equals to gross NPA minus provision divided by total advances. Capital adequacy ratio or capital to risk weighted assets ratio equals to total capital divided by risk weighted assets. Higher capital adequacy ratio is good. Next, other important points for solving the problems. First one, transferor company is called as a selling company or vendor company or target company. Transferee company is also called as purchasing company. Is to means for in mergers and acquisitions. Is to means for. If question is silent, post-merger price earning ratio equals to pre-merger price earning ratio of purchasing company. Maximum exchange ratio is calculated from purchasing company's point of view. MPS of purchasing company before merger should be same after merger also. In case of maximum exchange ratio. In case of minimum exchange ratio, it will be calculated from selling company's point of view. MPS of selling company before merger should be same after merger in case of minimum exchange ratio. That is, post-merger MPS equals to equivalent MPS. Return on equity equals to EPS divided by book value per share into 100 or total earnings divided by total book value into 100. Book value means equity share capital plus reserves and surplus. Growth equals to B into R. B means retention ratio. R means return on equity. B, how to calculate B? Retention ratio equals to 1 minus DPR, dividend payout ratio. Market cap equals to MPS into number of shares or EPS into price earning ratio. If question is silent regarding calculation of swap ratio, calculate based on MPS. Next, promoters' holdings are not freely traded. How to calculate number of shares, equity share capital divided by paid up value per share. In case of bonus issue, reserves decreases because bonus is issued by utilizing the reserves. Price earning ratio equals to 1 by KE. KE means capitalization rate. How to calculate NPA percentage? NPA percentage equals to NPA divided by advances into 100. In case of amalgamation in the nature of purchase, reserves and surplus are not taken over by purchasing company. How to calculate terminal value? Future value for n years equals to free cash flows to the firm for n plus 1 year divided by KO minus G. Value of equity equals to value of debt, value of firm minus value of debt. Value of equity equals to value of firm minus value of debt. Value of acquisition equals to value of firm after acquisition minus value of firm before acquisition. True cost of acquisition or net cost of acquisition. It is the gain to shareholders of the selling company after merger. How to calculate true cost of acquisition or net cost of acquisition? Post-merger market cap of the selling company minus pre-merger market cap of the selling company gives true cost of acquisition or net cost of acquisition. How to calculate KE? KE, RF plus beta into R minus RF, or another formula D1 by P0 plus G. P0 equals to D1 by KE minus G. How to calculate book value or equity funds? Equity share capital plus reserves and surplus minus deferred revenue expenditure minus preliminary expenditure. Deferred revenue expenditure and preliminary expenditure will be deducted only if appearing in asset side of the balance sheet. Or how to calculate book value or equity funds? Total assets minus deferred revenue expenditure minus preliminary expenditure minus total outside liabilities gives book value or equity funds. Next, equated annual installments equals to loan amount divided by present value annuity factor at the rate of R for T years.